Yesterday, markets froze. Trading halts. Dot margin hikes by buttons that suddenly stopped working. Most people assumed that was the crisis. It wasn't. While screens went dark and traders argued online, something far more important was happening. Quietly, efficiently, and without a single headline. Silver was leaving. Not paper contracts. Not physical metal. Leaving warehouses. Leaving vaults. Leaving the Western financial system. And once it left, it didn't come back. The illusion of controlled financial markets are designed to pull your attention upward toward numbers, charts, and flashing alerts. But real power doesn't live on a screen. It lives at loading docks dotted ports, on cargo manifests. While Western investors were trapped inside halted markets, metal was being moved under their feet. Ports in New York, ports in London, facilities that hadn't seen activity like this in decades. The scale wasn't incremental. It wasn't cautious. It was urgent. Veterans of the logistics industry described it as something they had only read about: mass movement of strategic material, executed fast without negotiation. This wasn't trading. It was evacuation. Why the paper price stopped mattering for years. Silver existed in two worlds. One was visible: futures contracts, spot prices, charts that moved by cents. The other was physical: bars, coins, industrial stockpiles. Most people believed that these two worlds were connected. They weren't. They were loosely stitched together by trust, and that trust just snapped. As paper markets froze, the physical market kept operating, and when arbitrage opened, it opened violently. Silver in Asia began trading at a massive premium to Western prices. Not 2%, not 5%. Double-digit. In commodity markets, that kind of spread is not a signal, it's a vacuum. The economic law nitro monoxide 1 can break. You don't need conspiracy theories to explain what happened next. You only need basic economics. If a refinery can sell the same bar of silver for $67 in New York or $80 in Shanghai, there is no decision. Metal flows toward the higher bid. Always. No patriotism, no loyalty, no ideology. Just math. And once that gap appeared, the outcome was inevitable. The West made a fatal assumption. Western markets assumed silver was abundant. It wasn't. They assumed inventories were deep. They weren't. They assumed paper claims could always be rolled, settled, delayed, or offset. They couldn't. Not when someone demanded delivery. And that's the key difference. Western buyers were content with exposure. Eastern buyers demanded possession, allocated, segregated, delivered. No promises, no substitutions, no cash settlement. Metal or nothing. The inventory problem, nitrogen monoxide, one wanted to discuss official inventory numbers, had always been opaque. Eligible, registered, available. Most investors never bothered to understand the distinction. They should have. Because only one category actually matters: metal that can be delivered. And that category wasn't shrinking slowly. It collapsed. Paper claims multiplied. Physical supply didn't. The ratio became absurd. Hundreds of claims for every remaining ounce. That's not leverage. That's insolvency. This is where part 1 turns dark at this point. The story stops being financial and becomes strategic. Because the buyer draining the system wasn't a hedge fund. It wasn't a bank. It was a state. A state with manufacturing dominance, military ambitions, and a clear understanding of material science. Silver isn't a precious metal to them. It's an industrial input, a critical one, and they were buying it like oxygen. Cliffhanger end part 1. This wasn't about profit. It wasn't about speculation. It was about preparation. Because when supply chains tighten and conflict escalates, the side that controls materials doesn't just win economically. It wins everything. And that raises the question the West still refuses to ask. What does China know that forced them to move first? And move this fast? The mistake everyone makes about Siachina, let's kill the cartoon version first. China didn't do this out of spite. They didn't do it for headlines. They didn't do it because of ideology. They did it because they ran the numbers. While Western analysts were arguing about inflation prints and rate cuts, Chinese planners were studying something far more boring and far more decisive. Material sufficiency under stress. Wars are not fought with money. They are fought with inputs, and silver sits at the center of modern warfare in a way almost no civilian understands. Silver is not a luxury, it's a weapon. COMPONT. Every advanced military system relies on silver, not because it's pretty, because it works. Missile guidance systems, radar arrays, satellite communications, secure data links, drone swarms, power management system, silverize NT. Nice to have, it's non-optional. You can substitute copper in some places. You can cheap out on aluminum elsewhere. But when you need maximum conductivity, minimal signal loss, extreme reliability, there is no replacement. And China knows this. Timing matters more than PRIC hears. The part Western investors don't understand. China didn't buy silver because it was cheap. They bought it because it was still available. They watched inventories shrink. They watched production stall. They watched demand accelerate from solar EVs, grid upgrades. Semiconductor manufacturing, they saw the same data everyone else did. The difference is, they believed it. Global mining was already phalange before any drain began. Silver was already in trouble. New discoveries were declining, grades were falling, production costs were rising, environmental restrictions were tightening. Silver is rarely mined alone. It's mostly a byproduct, which means you can't just turn on more supply. When demand spikes, supply doesn't respond. It fractures. It fractures. China understood that years ago. The Belt, the Road, and the real agenda. The Belt and Road Initiative isn't about diplomacy. It's about resource lock-in. Infrastructure at scale requires power, connectivity, electrification, all of which requires silver. China isn't building for the next quarter. They're building for the next 3 decades. And they are doing it while the West still believes markets will figure it out. Markets don't solve shortages. They expose them. WHY London broke. FRSD London wasn't the villain. It was the weakest link. The LBMA runs on a system that only works under one condition. Most participants never ask for delivery. Unallocated accounts, metal leased multiple times. Claims stacked on claims. It's not fraud in the legal sense. It's assumption-based finance, and assumptions fail when reality shows up with a truck and a bill of lading. China didn't accept cash, and that was the TLL when stress hit. Western institutions tried their usual playbook. Delay. Cash, premium, paper, settlement. That works with hedge funds. It doesn't work with states. China didn't want dollars. They didn't want premiums. They didn't want promises. They wanted metal. And when they insisted on delivery, the system cracked. This is where the paper market dies quietly. Don't expect fireworks. No emergency press conference. No admission of failure. Here's what actually happens. Delivery requests are encouraged to settle in cash. New contract rules quietly change. Force majeure clauses are activated. Transparency decreases the paper market. Docility explode. It atrophies. Liquidity vanishes. Participation drops. Trust erodes, and once trust is gone, leverage becomes poison. Force majeure is not a theory. It's a blueprint. Force majeure, ISNT, about acts of God. It's about legal escape. When contracts cannot be fulfilled, the system protects itself, not you. Settlement happens at a price convenient to the issuer, not the holder. That's how paper markets end, not with default, but with redefinition. The price split nitrogen monoxide one is ready. For this is the moment people misunderstand. Silver doesn't go to infinity. That's lazy thinking. What happens instead is worse.